Today is Monday, January 19th, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. And as always, from an advisory board perspective, today I start a new theme for this week. I'll be talking about something boards often underestimate. And I'm going to use a live listed alternative investment market company on the London Stock Exchange that I'm watching. And its cornerstone is a new UK small and medium enterprise challenger bank, which is very fascinating and positioned to lend into the underserved markets. So the bank secured a regulatory milestone, but full authorization is explicitly conditional to raising a minimum of £25 million in regulatory capital. And so that's the gate that they have today. A restricted banking authorization milestone that feels like the finish line, right? So, we raise the money and we're there. But it isn't. It's actually it's a starting gate. It's not the finish line. So now this company is what is called in mobilisation from the authorization with restriction and the raise of the capital. They are close enough to excite investors, partners, and the media, but they are also exposed enough to delays, dilutions, and governance gaps, which can get expensive. So let's explain what is mobilisation first. For a public listed company seeking to set up a new bank in the UK, like this case, mobilisation refers to an optional regulator approved stage where the firm is granted authorization with restriction before it's fully operational. So in other words, yes, but, and I'm going to go through that later. So where is the situation today? The listed vehicle has been bridging the gap. It means that in their disclosed, they advance to the bank totaling 1.5 million as September 25. It reports interim numbers showing a loss of circa 600k and for the fixed 6 months up to September, and net assets of 3.8 million and 1 million in cash. So this is not theory. This is a real-world mobilisation story with real capital pressure and real board trade-off, which I think is fascinating for our advisory themes. So let's take a look at three problems with this situation. Problem number one, as mentioned, a restricted authorization is a yes, but. You have regulatory momentum, but you will still have gating conditions. In this case, the public disclosures are clear that full trading permission is conditional to a minimum capital raise of 25 million. Until that is achieved, the business cannot fully launch. Problem number two is that mobilisation still requires ongoing compliance. The Bank of England's new bank startup unit set the expectation that firms must meet the Prudential Regulation Authority and Financial Conduct Authority threshold conditions from the point of authorization and continue to meet all of them through the mobilisation. So the thinking of we'll sort this after funding is probably the wrong mindset at this point. You are required to an ongoing compliance through all this period until raising the funds. And problem number three is the bridge cannot distort the listed vehicle. Remember that we say 1.5 million in bridging. This case includes multiple funding mechanics, including that is close to the market, including the 3.5 million package involve equity and a 3 million converted facility, plus at the market facility up to 12 million. If boards do not control the narrative and the guardrails, bridge funding becomes a rolling governance and a dilution risk. Remember that the market facility is a flexible way to raise capital by selling newly issued shares into the open markets, and this is up to £12 million. So it's a quite interesting facility. Now, what has happened so far? In other words, mobilisation is like being cleared to board the plane. Imagine that you're in the airport and say, everybody on board, then being told the plane cannot take off because they have to fuel it. But you're committed, you're already in the plane, but still at the gate. The doors are not closed yet. So what do you do as a bored when you got a valuable regulated milestone, but the business still can't trade properly. So, as a board advisor, I will propose to consider in what I will propose to consider in this case is the following: is to stop treating mobilization as a dead time, like a regulator say, yes, now we have to raise this money, but run it as a measurable build, right? So there's three suggestions. Number one is a build mobilization scorecard that the board can actually steer, tied to regulators' expectations, not to internal optimism. So use the milestones like a capital plan progress, governance readiness, liquidity runway, and operation capability build. And the Bank of England's mobilization framing gives you the logic for this. So actually, it's not something that you had to think about how I'm going to put this together. So the Bank of England mobilization framing already gives you a logic for this. Suggestion number two: separate gating from progress. Your gate is a condition you cannot bypass. It's a minimum 25 million capital requirement. Your progress is everything that makes the gate fundable: credible controls, credible technology, credible people, and credible reporting. So treat these as board level deliverables. And suggestion number three is ring fence the bridge mechanics with guardrails. If you are using instruments such as equity subscription, convertibles, and at the market facilities that we mentioned already, make the board's constraints explicit. Define the purpose, the wrong way it buys, the triggers to stop, and the conditions to double down. In this case, for example, the 3.5 million investment management firms package structure disclosed shows how quickly structures can become complex even before the bank launches, right? So here's we could say, an uncomfortable truth. In mobilization, you are selling belief. Regulators need, but sorry, you are selling belief. This is what we're going to do. But regulators need confidence, investors need confidence, and future customers need confidence. So belief is built through evidence. Yeah, so you are selling belief, but it requires evidence, which is the best defensible position that you can ever have. You cannot do that through slide decks. So why does the confidence approach matter? For three things. First is the outcomes, second is the differentiator, and the third is the risk reduction. As an outcome, a board-ready mobilization plan that turns restricted into ready. This case shows what boards must track: the 25 million pound gate, the advances used to maintain operational continuity, and how interim reporting frames progress and risk during that mobilization. As a differentiator, translate regulatory expectations into board controls. And remember, the Bank of England's new bank startups unit outlines the logic of meeting the threshold conditions through mobilization. So turn that into a practical scorecard and cadence that boards can govern. And cadence is a kind of a calendar schedule that you have there. And risk reducer, de-risk the capital breach. The market disclosures show how quickly bridge funding can involve multiple instruments and moving parts. So put decision guardrails around dilution, runway, and triggers while keeping the story investable. So what's next? So one action you can do in less than 30 minutes is draft a one-page mobilization scorecard with these 4 lines: gate, runway, readiness, and evidence, and give each one of them a red, and amber, and green status, and beside that, a measurable next step. Whoa, so let's pause it here for today and reconvene tomorrow, because this is a fascinating case. Because tomorrow I will continue with this company, by the way, as a real and current mobilization example, and show you how to stop a single gate like the 25 million capital condition from hijacking valuation, governance cadence, and the market narrative while you are still on mobilization. And as usual, if this mirrors what you're seeing inside your organization, you'll probably want to stay with this series until Friday. And if you are looking into understand what's your position, where you want to go, and look for an advisory board that can see this from different perspective and help you to put all this together, just book a DM me through LinkedIn or book a call, and we'll take it from there. So have a great day and see you